Today in the markets, we see increasing debt levels across the world, as well as strong economic indicators suggesting a rebound. The S&P 500 hit a new high today, rising up 1/3%. The Dow Jones had an even better day, up 0.69%. The Nasdaq was also up 0.42%. In Canadian markets, the S&P TSX Composite Index didn't fare as well, falling over 0.5%. Both the FTSE 100 and the Nikkei were up on the day, but down on the week. Oil was down 1.33%, and gold was flat on the day. Looking at treasuries, the US 10-year was 64 basis points, and the Canadian 10-year was 54 basis points. In the currency markets, the US dollar saw some recovery, as well as the Canadian dollar, the Japanese yen saw some strength. The British pound, though, had a rough day. While we are seeing many instances of an improving economy in many countries around the world, through improved economic indicators, and even some that show gains from pre-pandemic levels, it's important to note that many of this is being fueled by government debt and business debt. As you can see here, the British government debt level has surpassed that £2 trillion mark for the first time. That's roughly 2.6 trillion US dollars. In July, they increased their debt level by 26.7 billion pounds. Their GDP, their debt to GDP is at 100.5%, which is the highest level since 1961. Though they have seen some positive signs, as their retail sales have seen a 3.6% gain monthly and are actually 3% higher than the pre-pandemic levels. A lot of this is fueled by the debt the government is paying, as many jobs are being saved by government stimulus, as well as just overall money going out to people. This does cause some concern to me, as things may be looking good right now, but once the government rolls back on their spending levels and we start to see possibly some increases in defaults by companies as companies file for bankruptcy, as well as people starting to get evicted as evictions take hold, as people are able to pay back the rent that they weren't able to pay because of the pandemic, we could see a future negative GDP growth and another recession in the coming years. Government debt isn't the only concern, as a fascinating article points out about the increase in corporate debt in America, as well as the issues in their credit metrics. So as you can see here, the total amount of debt is over $1.6 trillion that have increased because of the pandemic, as companies need this debt to try and stay afloat. Though it's worthy to note, some companies are using this to try and get lower interest yields, as there are lower rates currently. But at the same time, these are pretty high levels of debt, and many companies are having a deterioration in their credit ratios. Some notable examples here is that their total debt to EBITDA for investment grade companies is at 3.53 times, which is higher than earlier this year of 3.42, which is the highest since 1998. Just looking at the 20-year average is at 2.65, so that's a pretty drastic increase in the level of debt for how much money companies are earning. And that is only looking at investment grade quality debt. Looking at high yield debt's levered ratio, it's at 5.42, which is up from March's 4.95 and up from the end of 2019's 4.44. So there is an increase in companies' not ability to pay their debt back. That is even considering that there are lower interest rates right now, but the decrease in earnings and increasing costs that companies are facing due to the pandemic is really hurting them and could take a toll in the coming months or years. An interesting aspect that this article pointed out is that due to this higher level of interest payments because they're increased in debt and they have to pay this debt back, is that in the future, these companies won't be able to invest in, say, new employees, new projects, because more of their cash will be going back to that debt. So in turn, essentially, you're reducing the amount of growth that they are going to be able to achieve. Looking at investment grades debt in terms of their interest coverage, it has fallen down to 5.8 compared to the 20-year average of 7. It is worthy to note that the ratings agencies are taking this into account and that they are slowly, if not surely, starting to downgrade companies at a faster rate than in the past decade. It is worthy to note, though, that 80% of the companies so far in Q2 have beat their expectations, but that is still down one third compared with the previous year. I thought they put a really good quote in here at the bottom, which says, "This cycle is very different because we've had so much support from central banks and we have so much liquidity in the market," Jones said. But the old saying, liquidity does not equate to solvency, is something people need to keep in mind when they're investing. All worrying aside, have to take note that there are good, strong economic indicators coming out of the United States, with the US housing market heating up. In July, they had a record sales of plus 24.7% from the previous month, and that is even above what happened last July and is an 8.7% increase year over year. Looking at the seasonally adjusted annual rate of units sold would be 5.86 million. This increase is partly due to the lowering of interest rates. As it says here, the average rate on a 30-year fixed mortgage rate is now 2.99% compared to a year ago's 3.55%. It's a fairly big drop in interest rates have led to the increase in buying, but at the same time, should look at the previous months that have been lower than the past year, as many buyers probably returning to the market. It's worthy to note too that the supply of houses is fairly low compared to the previous year, as the number of units for sale is roughly 1.5 million, which is down 2.6% month over month and 21.1% year over year. Home prices have also seen a dramatic increase year over year, and for the first time have cracked the median home price of $300,000 to $304,100. That is up 8.5% from July 2019. So the housing market is really heating up in the United States, and I'd pay special attention to that and see where that goes. The US business activity has seen an expansion also in August at a decent rate, as the IHS Market Flash Composite Index of purchasing managers and manufacturers and service providers saw an increase of 4.4 points to what is an 18-month high of 54.7. Fairly strong results. As you know, anything above 50 means an expansion. There was also numbers coming out of the manufacturing PI, which is at 53.6, while the service index was at 54.8. There saw a decrease in Europe, which dropped down to 51.6 from 54.9. And looking more into Asia, you see the Australia as well as Japan's heading is at negative territory. We've also seen some job news coming out of the United States yesterday, as jobless claims rise to 1.1 million, which is actually an increase from the previous week, which is a slightly worrying sign, but overall not too high compared to all the previous weeks. Total collected unemployment did fall though, down to 14.8 million, down from 15.5. The current unemployment rate is about 10.2%. Just looking at the total numbers of jobs gained and lost during the pandemic, they've added 9.3 million jobs, while they've lost 22 million. It really shows you that we are seeing slight recovery, but we still haven't even achieved half the jobs lost in the United States, so still some concern there. Canada posted strong retail earnings for June, which was up 23.7% month over month. This is the first month that they've seen an increase above February's levels, which is 1.3% increase. It's estimated that July will see only a 0.7% increase, though. While this number is good for June, it is slightly below estimates of 24.5%. The increase in retail sales was strongly led by the motor parts as well as motor vehicles sector, which was up 53.4%. If you exclude that, the gain was 15.7%. In Saudi Arabia, The oil company Aramco has announced that they are suspending their $10 billion project to build an oil refinery in China. This is essentially them trying to reduce their capital spending by cutting costs as they plan to maintain their $75 billion dividend amid the oil price collapse that's happened this year, as they aren't able to achieve the same income as previous years and have had to reduce their oil spending. This seems to be happening a lot with oil countries and just oil companies in general, as we see even many of them defaulting. Though it is worthy to note that the Chinese side said that they are planning on going through with the project. Lastly, I just thought this article was kind of interesting, which talks about the CEO of an education platform, Chegg. His name's Dan Rosenwig, who's saying that 25% of colleges could possibly go out of business and basically file for bankruptcy. This is amid classes not happening, the move to try and going online, and less funding going to these schools. Not really sure exactly how many will end up defaulting or closing down, but it's just an interesting thing to note.